Excellent. I'd like to welcome everybody to the New England CCIM chapter webinar. We're fortunate to be hosting CoStar today, and we're going to be discussing multifamily trends in New England. No, hold on, give me 1 second here. Bear with me. We're fortunate today where I think most of us know CoStar. They're the leading provider of data analytics to the commercial real estate industry. And we're joined by a couple of their economists. I am Dave Gambaccini. I am principal with Excel Capital Partners in Bedford, New Hampshire, and I am the president of the New England CCIM chapter for 2020. With me today from CoStar is Mark Hickey, director of analytics for New England. He's been with the firm for about 15 years, focuses his time on the an analysis of market trends in Boston and greater New England. Mark's been quoted about commercial real estate markets in major metropolitan newspapers and national media, including Boston Business Journal, the Boston Globe, and the Wall Street Journal. Prior to starting CoStar, he spent 10 years working in financial services for some of the nation's leading investment banks. Mark received his BS in finance and economics from the Whitman School of Management at Syracuse University, and he got his MBA from the Carroll Graduate School of Management at Boston College. Todd Galvin is the Associate Director of Analytics for New England with CoStar. In his role, he identifies analytical trends throughout Boston and greater New England. He is responsible for writing, forecasting, and maintaining CoStar's market and submarket reports across all commercial property types. In addition, he works with clients to identify market trends, opportunities, and risks. Todd received his bachelor degree in financial economics from the University of Lynchburg and has been with CoStar for about 4 years. So listen, guys, we're really happy to have you here today. We're looking forward to getting into some of this. Oh, there we go. There's those handsome guys. And just for some housekeeping, so everyone knows, this is being recorded. We will share the recording. We will share the slides that CoStar presents. I do encourage active Q&A. So I'm going to be trying to monitor the Q&A box. And as you have questions, certainly drop them in there, and I will jump in with Mark and Todd as necessary. And yes, there's Ernie checking the Q&A. Ernie, I don't see anyone. Everyone's cameras are off, and your only communication with us is via Q&A. So, but Ernie, I do see that you're there as an attendee. I'm going to hand it over to you guys. Certainly check out the New England CCIM chapter YouTube channel. We're trying to post content like this after we do these meetings. And we're going to try to re-explore some of this with CoStar in the future. So welcome your feedback. And without further ado, Mark, Todd, I'll hand it over to you. I'll start sharing my screen and let you guys pick it up.
All right, great. Thank you.
Thank you, guys.
Just share my screen here.
Okay.
Looks like you might need to enable my screen sharing.
I'm sure you're right. That's one. Get that one. There we go. Try that.
All right. Great. Got it. All right. And can you hear and see me and see Todd at the same time?
Absolutely.
All right. That actually makes things easier. Great. All right. So as Dave said, I'm the Director of Analytics for New England. I'm going to be joined by Todd, the Associate Director of Analytics for New England. And we're going to cover multifamily in New England, kind of with the exception of Connecticut. As I try and get this thing to advance to the next slide. So these are the areas we're going to be talking about. We're going to spend a lot of time talking about Boston. We're going to use the government's definition of the metropolitan statistical area, which you can see is quite large. It's based on commuting patterns. So if you notice, it actually includes the 2 counties in southern New Hampshire, Rockingham and Stratford counties, right? So kind of Portsmouth, New Hampshire area. And it's based on commuting patterns. So there's not people from southern New Hampshire that commute into either northern Massachusetts or Boston itself, but they group it into the metro. If you've got a keen eye, you may notice that Bristol County on the south there, part of Massachusetts, is actually included in metropolitan Providence, not metropolitan Boston, because there's more people in that county that commute to Rhode Island than the other counties in Massachusetts. We're going to talk about Worcester, which is pretty much just Worcester County, but it also includes Windham County, kind of the top right-hand corner of the state of Connecticut. This is Providence, pretty much all Rhode Island and Bristol County. We're going to talk a little bit about Portland, Maine, which is pretty much Portland all the way down south to, kind of Kittery, York area. And we'll also talk about, what's going on in Manchester, New Hampshire, which is pretty much just Hillsborough County. I'm going to start off with the national economy. And what we're seeing right now with COVID-19 is more akin to a natural disaster than it is a typical recession. So what I have on that blue line, this is the kind of initial percentage of initial job claims, and that's the Great Recession, right? You can see that kind of chugging along, where you can see that the COVID-19 and Hurricane Katrina in red and green, right? This is their initial dramatic shock of job losses. And that's really what we're going through now. Again, more like a natural disaster than a typical recession. This can be seen here as well. If you look at the cumulative numbers of jobless claims, right, we can see that blue line gradually moving up, right, as those numbers continue to roll in. But if you look at COVID-19, again, compared to Hurricane Katrina, there is this initial shock, right, and then a gradual rolling up of the cumulative numbers. Across the United States, jobless claims continue to roll in at very, very high numbers. Now, the state of Massachusetts, we're more than 90% of the way through our jobless claims. Some states, however, are not. If you look at Florida, for example, in previous years, the state of Florida made it purposely hard to file for unemployment because the state didn't want to pay out the unemployment claims. And a lot of other states, right, they're continuing to roll through their unemployment claims. This is the unemployment rate, which was released about 3 weeks ago today, I believe. And you can see the unemployment rate is about 15%. However, there is a difference between the unemployment rate and jobless claims. A lot of people think that the two are the same. The unemployment rate, the number that you always hear quoted in the news, is actually a survey number. It's a phone survey of about 60,000 people across the US. Now, what we've seen is that a number of people on this survey are believed to have answered that survey incorrectly, meaning that they were furloughed from their job and they consider themselves employed, but they are actually, technically been laid off. So if you were to include all those workers, the unemployment rate in the US, instead of being 15%, is more like 20%. Another thing that they ask you in the survey is, have you looked for work this week? If you have not looked for work this week, you do not get counted in the unemployment rate. This is important, right? Because if you're a chef at a restaurant, for example, and you got laid off, and they ask you how you look for work this week, the answer is probably no, right? Where else are you going to go? You're hopefully going to get your job back at the restaurant you were at, right? That's what you're waiting for, that restaurant to open so you can go back to work. So what we might see is a lot of these people that have not been looking for work will start to look for work, especially as these unemployment subsidies, right, start to burn off. And as a result, I think the unemployment rate will continue to creep up over time, even as people are going back to work. So if we look at Massachusetts, if we take the unemployment claims and call those people unemployed, right, as an unemployment rate, it'd be closer to about 25 or 26%. That's the highest going on record to the late 1930s when we started tracking the unemployment rate. Now, again, further to that point, about 80% of the layoffs so far have been furloughs, meaning temporary layoffs. But I think that a lot of these are going to convert from temporary into permanent layoffs. This is slide is a little bit dated at this point, but this is from the end of March. This is what a lot of investment banks were thinking in terms of what GDP would look like in the second quarter. Those all those blue bars. If you look in the middle there, DB, Deutsche Bank, GS, Goldman Sachs, you can see they're calling for about a 30% drop in GDP this quarter. It's important to note, if you look at the yellow bars and the green bars, that's GDP growth during Q3 and Q4. So while there's this huge drop in GDP this quarter, there's a giant rebound in GDP in the third and fourth quarters. This is this typical kind of V-shaped recovery that you hear mentioned so often, and I'm going to hit on that theme a couple of times throughout this presentation. Now, in my opinion, I think we might be looking at more of a Nike swoosh style recovery than that V-shaped recovery, and I'll show you more on what I mean in just a few charts. And one of the reasons I believe that is because of what we see in this chart. This is reservations via open table. And you can see, right, the reservation is completely cratering in the beginning to middle of March as all the states went on lockdown. And then as states started to open back up, we can see that reservations and open tables starting to come back in, right? But we can see that the drop was really steep and the recovery is, kind of gradual. And that's why I think rather than that V-shaped recovery, we'll end up with the, Nike swoosh in that, a lot of people are going to still feel uncomfortable going back to the gym, going back to restaurants, staying in a hotel, going to an amusement park, you name it. And I think it's going to take a longer time for the economy to recover. So this is a survey of business leaders in terms of how long would it take you to get back to business. Now, if you look at that giant orange line, this is the survey that was given in the beginning of March. Most people said, hey, look, I can get back to regular business in less than a month. But as time has moved on, those survey answers have moved from less than a month to 1 to 3 months, 3 to 6 months. There's a significant period that it's going to take them more than 12 months. So it's not like even if we ended up, came back with a vaccine or herd immunity or what have you, that, business can, ramp right back up. Now, in terms of the Boston economy, I want to talk a little bit about history before I talk about the future. Now, recessions have been disproportionately hard on Boston. Boston is in the green line, the US average is in the black line. So if you look at the US average during the Great Recession, we can see a 6% contraction. You would have to go all the way back to the Great Depression to find a contraction in jobs that strong. Well, at least until now anyway. Now for Boston, we actually got off lighter during the Great Recession with a 4% contraction. But we don't have to go back to the Great Depression to find steep job losses. We only had to go back to the tech wreck in 2001, where job losses were about 7% or almost double what they were during the Great Recession. In the recession of 1991, that was even harder on Boston's economy, with job losses about 3 times as hard as they were during the Great Recession. Now, during the double dip recession of the early 1980s, due to rise in interest rates, Boston got off a little lighter, but then again, during the OPEC recession in the 70s, Boston got hit harder. So in general, Boston gets hit harder. This time around, we think that it might be a little bit different and that Boston will probably be impacted about the same as the average US metro. So you can see Boston here is in orange and US average is in blue. Now you don't see much orange because the history and the forecast for Boston and the US average are almost identical, so they overlap. Now, on our forecast, what we're calling for right now is a typical V-shaped recovery. That's still what a lot of economists are calling for. So in that V-shaped recovery, that means that we get back to pre-pandemic employment levels, so what we saw kind of in February of this year, in about 2 years. I looked at all the recessions since World War II, and this is about the average time period, or maybe a little bit shorter. So while this recession, as you can see, is calling for losses about 15%, so really, really steep, right? About 4 times as hard as the Great Recession was on Boston, right? The duration is going to be shorter. So it took us about 6 years to get back to, pre-Great Recession job levels, but we think this time it's going to be about 2 years, which is a normal recession. Also, this is what I'm talking about when I say a V shape. Now, the time period is a little zoomed in. So if I zoom out of the time period, right, you can really see what I'm talking about when I say that V-shaped recovery. Now, in my opinion, we're going to end up with that Nike swoosh style recovery, which kind of looks like that reservations for open table, right? Kind of a slow, gradual return to, normal business. Now, if you look at Boston's economy, we're really driven by a number of different sectors. The first one is professional business services. And the way this chart works is this. The green bar is Boston. So professional business services is about 19% of employment in our metro, where it's only about 14% across the US. So what happens in professional business services, which in Boston is high tech, hits us harder than it does a typical US metro. We actually have about double the number of high tech jobs as your typical US metro does. Next up is health services. We have, again, a very, very strong concentration in health services. This is actually something throughout the Northeast. So if you look at Providence, Worcester actually has a bigger concentration than Boston does. Springfield has an even bigger concentration than Worcester does. So health services is something that has been typically very stable throughout this, throughout recessions, but this may not be the case this time around. So if we dive into health services, that's that red line there versus the total employment of Boston, which is that black line, right? You see that the red line does not have any losses in 2008, no losses in 2001, no losses in 1991. There was some losses when the economy was absolutely on fire in the late 1990s as there was consolidation in surround healthcare across the country, but it's been virtually recession-proof. This time around, though, this appears not to be the case. Right, so if we look at Atrius Health, they've laid off, furloughed 1,100 workers. Tufts Medical Center, Boston Medical Center, about 700 workers apiece. All right, so this is because all the elective surgeries have been canceled. You don't have the regular doctor's visits, the regular dentist visits, etc. Now, while I believe that the regular economy is going to have kind of that Nike swoosh recovery, I think that healthcare will, in fact, have a V-shaped recovery, and losses here will probably be light. I think it's going to be V-shaped because if you had an elective surgery, you're probably going to try and put that back on the schedule as soon as you can. And if you have a toothache, right, you're eventually going to go back to the dentist. And if we look at high tech, we can see the volatility of the high tech sector, right? If you look at the job gains during the tech boom and the job losses during the tech bust. And, you know, we've heard some talk about tech being somewhat immune to this. And if you look at the big companies, Google, Microsoft, Facebook, Apple, yeah, right, they're doing great. In fact, Facebook and Apple, they're hiring people. They're not laying people off. But, you know, tech is not just Google and Microsoft and Facebook and Apple. In Boston, we have a lot of companies, including biotech companies, that are being adversely impacted by what's going on. So, if, for example, if you look at Boston Scientific, based in Framingham, they have about 36,000 employees worldwide, and they, rather than laying one off, they gave everyone a 20% reduction in salary. If we look at Zipcar, again, these are companies based in Boston that are announcing layoffs or will be announcing layoffs. Who has anywhere to go in a Zipcar, and who'd want to get into a Zipcar when you have no idea who's been in it, 10 minutes ago or an hour ago or what have you? If we look at Toast, they sell software to the restaurant industry. I'll talk more about them in a second. DraftKings presently, hopefully soon though, but presently there is absolutely no sports to bet on. If we look at care.com, well, I would love to have a babysitter. Probably don't want to have a babysitter into my house. I'm sure babysitters don't want to come to my house. Care.com is a software that kind of screens and allows you to get babysitters. Lola, they do corporate travel, which has obviously been almost entirely curtailed. So if we look at a list, this is a great source if you want to go to layoffs.fyi.tracker. I sorted here by Boston, right? You can see the top company, Toast. I sorted by the number of people laid off. They laid off 1,300 workers, or about 50% of their workforce, right? And we see other biotech companies, Sage Therapeutics, laid off about 50% of their workers, or 340 employees. So tech is getting impacted. Moving on to national apartment. So for those who aren't aware, CoStar owns apartments.com, For Rent, RentPath, about 11 other ILSs, Internet Listing Services. And what we're seeing right now is more traffic than usual on apartments.com and those 11 ILSs. And it would make sense, right? People are hesitant to view an apartment in person. So they'll either, one, try and view it entirely online, or two, view it online first, narrow down their searches, and then maybe look at only one or two apartments. So we're seeing an increase in our search activity. Now, right now, across the country, in terms of daily apartment asking rents, broken out by star rating. So 4 and 5 star, that equates to Class A. 3-star equates to Class B. And what we're seeing now is a bigger impact in terms of rents on the higher end of the market than on the lower end of the market. Now, given that all the restaurant workers, the hospitality workers, et cetera, are generally in kind of that workforce housing, B and C housing, you would think that that B and C should be getting hit harder than Class A. But with the federal unemployment insurance on top of your state insurance, the federal adds another $660. Right now, at least some of the workers, maybe not all, are actually doing a little bit better than they were previously in terms of how much money they're bringing in, although that's short-lived. This thing ends in July. So as a result, what we've seen across the country here on this slide, this is from NMHC, and they survey about 12 million units. And if you look at May of 2019 and May of 2020, right, we were at a 82% collection rate and then an 80% collection rate, about 150 basis points difference between May 2019 and May 2020. Because again, these workers have had salaries coming in. Most landlords at this point that we talk to are really kind of more scared about August when that starts to burn off. And then what you might see is kind of the dip in B and C housing rather than A housing. Now, traditionally, A does get hit harder in recessions because you can trade down from A into B into C. But this time around, right, what we might see is kind of that dip in August where it's reversal of the regular trend. Now, given that we have so many, or so much student housing, not only in Boston, but also in Worcester and in Providence and Southern New Hampshire and Maine, et cetera, I thought it'd be worth talking about what most schools across the country are planning on doing. And you can see that green piece of the pie, 67% are planning for in-person classes. Another 7% are a hybrid, although really the in-person classes I think are somewhat hybrid too. And only a small portion are planning for 100% online. So this is good news. The thing that really kind of remains to be seen is what happens with international students. As well as I understand it, once you have a visa as an international student, that's good from the beginning it was issued until you graduate. So if I'm a student in China and I went home, I should be able to re-enter the country without having to get a new visa. This is particularly important for schools like Northeastern, where 60% of the students are foreign students. Freshmen, though, might be harder. We've read the news that some of these schools are now scooping up students off the wait list that can pay full tuition, which is usually what the international students do. And the domestic students get the break on tuition. But what the schools really haven't announced is what's their plan for housing. So what you might see is you take an open double or an open triple, which seems like a bad recipe, right? To have those type of housing arrangements. And some of those students might get moved to off-campus housing. And then a school is going to have a separate dorm or a hotel. Boston University, for example, in years past, when it oversubscribed the number of students, rents out an entire hotel for a semester or 2 semesters. And what you might have is that they need a separate hotel or dormitory for the students that, number one, have an active case of COVID-19, or the contact tracing. You don't have an active case, but you were sitting right next to this person in class. So if you have to empty out a dorm or more than one dorm, that again might put some students into off-campus housing. All this remains to be seen, going to play out over the next, call it just 3 months. What we might see is something similar to seeing in the single-family home market, where there's going to be kind of a decline or a reduction in supply with maybe an increase in demand. Last slide here before I turn it over to Todd. So this, oops, hold on, I unplugged my thing here. Oops. All right. I'll wait till Todd speaks here while I plug my thing back in. So what we're seeing throughout New England is that rent growth, this is over the past 5 years. This is the trend that we saw, from 2015 to just before the pandemic. And what I did is I looked at rent growth, not only in Boston, but in Maine and New Hampshire and Worcester and Providence. And the best rent growth really wasn't in downtown Boston, really almost within 128, right? It was people getting pushed out to affordability. So what I did is, you can notice in the slide, I've color coded. So yellow is Providence, blue is New Hampshire, red is Worcester, green is Boston. The top markets for rent growth from 2015 to 2020 were Bristol County, right? You're cheaper, you can still get on the commuter rail into Boston, right? They had the best rent growth, and then followed up by some of the submarkets in southern New Hampshire. The first Boston one is actually all the way out in Lawrence, Haverhill, right? You can take the commuter rail in. So this is where the best rent growth was. People got pushed out of the edge of the metro due to affordability. So with that, I'm going to pass it over to Todd. He's going to talk about kind of what's going on in each metro in New England outside of Connecticut.
Great, thank you, Mark. So what I'm going to do here, what we're going to do is kind of go through each kind of metro and taking a look at some leading economic and real estate indicators. Here, we're looking at Worcester multifamily. Supply is your blue bars, your net deliveries, your orange bars are your demand, your absorption, and then your green line is your vacancy. So it pretty much paints the picture here, kind of a 10,000-foot view of the overall market. You can see, what I really want to focus on is, kind of the levels of construction. It plays a big factor in the overall vacancy rate, and we'll talk about kind of stabilized versus unstabilized and getting into the different types of classes, class A versus B. So here, for Worcester, Worcester has seen kind of moderate development for the past 10 years. It's below the national average in terms of inventory increases. Right now, there's roughly, right around 500 units underway. It's down, really has decreased from 2015, 2016 levels. And for the most part, you're seeing from 2020, moving forward, if we look, 5-year, chunk of time for the forecast, you can see vacancies, moderately, gradually rise, throughout the next couple of years here. And a big factor of that is the levels of construction. As we'll get to, later down the road, we'll see levels for Boston. Levels for Providence, is a similar story if you want to advance the slide here, Mark, to Providence, because it's a very similar story for Worcester. You're seeing more units underway, overall, but compared to the overall inventory, it's similar with Worcester and Providence. You're seeing vacancies really only tick up about 100 or so basis points, where national average is right around 200 basis points, and that a lot of that is due to the total levels of construction underway. Right now in Providence, there's about right around less than 1,000 units underway, which is kind of the lowest levels since 2015, similar to Worcester. But what Mark talked about, and it's particularly important for Providence, is where these multifamily units are being constructed. In Providence, a lot of these units that were completed in the last year or 2 years have been close to Brown and a lot of the universities in the area. So they, a lot of these apartment communities depend on, not entirely on the student body, but or the faculty, but to some degree, a lot of that demand is focused in those areas. So while Providence may have lower levels of construction than say Boston, the areas where they're being developed is definitely important to take note of. Moving along into Portland, I believe, yes. It's certainly a smaller market. You can see there hasn't been much activity until, maybe 3 years ago. You can see levels of construction ramp up. That is, for the most part, decreased entering into the pandemic. You can see right in the middle there in 2021, right around 250 units are expected to come online. But for the most part, not seeing too much vacancy increases for Portland. And similar to Portland, Manchester, definitely saw much more development. Mark, if you want to go to the next slide here, you can see, throughout the years, definitely more development starting, coming out of the '08 recession. But for the most part, Manchester follows similar suit to Portland, where now levels of construction have certainly decreased. It slowed prior to the pandemic, and you see vacancies don't really move up too much. Now getting into Boston, the chart's going to look a lot different. You can see, the levels of construction are a lot higher, and I'll talk about this more in a second. From 2010 to entering into the pandemic, the inventory in Boston expanded, about 25%. A fourth of the overall inventory was built, in the last 10 years. And these levels of construction are only ramping up. They're starting to see a slight slowdown over the last couple of quarters. But for the most part, construction is at all-time highs for, the last 10 years, the last decade. You can see the level, what that impact has on the vacancy rate. You can see vacancies expand about 300 basis points, about 100 or so higher than the national average. Boston is one of the heaviest development metros for apartment development. And you can see in the next slide here, you can see the levels of construction over time. You can see, starting off, it's just a slow, uptick in the levels of construction. Right now, about 7.5% of the inventory is currently under construction. If you compare it to the national average is about 3.5. So definitely Boston, is seeing a considerable amount of construction that will certainly play a factor, over the next few years as, we get into the recovery. I will note, the vacancy rate that you saw is a, unstabilized vacancy rate. If we look here, the green line is an unstabilized vacancy rate. Mark, if you want to move ahead to the stabilized versus unstabilized, you can see the overall vacancy rate includes properties in lease up, whereas the blue line, the stabilized vacancy, does not. So you can see the impact that overall construction will have on the overall vacancy rate versus the stabilized vacancy rate. These properties, I will note, once a property delivers, CoStar assumes that once one unit is available, that all units are available. We do not phase in the number of units, so it's not unlikely that when a property delivers, it delivers 80% vacant or 85% vacant. And that has a huge impact on the overall vacancy rate. So over the next several years or so, the stabilized vacancy rate moves up, a little over 4% to about 7, or for the stabilized vacancy rate moves up from 4 to 7, whereas the overall vacancy rate moves closer to 10%. And then if you kind of compare that, this is Boston, obviously, and then if you compare that to a Worcester, you can see the impact that construction will have on a Worcester. Same case for Portland and Manchester and Providence as well. The levels of construction definitely affects the stabilized versus the overall dramatically. Moving on to vacancies by class, a lot of this is for Boston. A lot of the new development coming online is your Class A, your 4- and 5-star property. You see there in the blue. You can see that the 3-star in orange and Boston overall, doesn't move up as much as your Class A properties. Most of the development really over the past really decade, and this is true nationally as well, and pretty much any metro that you go in, that all the development is towards these highly amenitized. You see it everywhere that renters want all the amenities, your pet washing stations, everything like that. So a lot of that development is in these Class A properties, which is why you're seeing the vacancy rate rise a little bit more. So I want to switch gears a little bit and get into rent growth. I'll talk about rents and the impact that we're seeing right now, and then I'll pass it back to Mark to finish up with the capital markets section. So here, Mark talked about it a little bit with the apartments.com. So here we're looking at daily asking rents in the Boston Metro over time. You can see you can see the seasonality of rents in this series. Usually in the spring, summer months, you're seeing rents steadily increase. If you look towards the end of the chart where we are today, you can see rents are actually falling, where they would normally increase. And if we want to dive into that a little bit further, you can see Boston rents. We started when we entered in right around $2.67 per square foot. 9 weeks later, we dropped to about 2.63%. Or excuse me, $2.63 per square foot, which is, if you take that 9 week period, is about 1.4%. It doesn't seem like a lot, but when you annualize that number over time, you can see there on the chart, it comes out to about 7%. And just to give some comparison, if we look at Las Vegas, a metro that has been hit, particularly hard with, by the virus, because a lot of the industry is based off of, a lot of the economy is based off of tourism. You can see, over time, it's about 1.4% similar, in a shorter week period. And if you annualize that, it's at about 8%. You can see there on the chart. But what's interesting to note in this chart, Mark, if you don't mind going back one slide, is that you can see, at the end of April, that rents start to flatten. And then, Mark, if you want to go ahead and move along, here we're looking at, if you look at from 2020 to 2021 here, we're calling for, our forecasts are calling for about 8% drop. If you look back to the daily asking rents, you can see that, it makes sense, for what we're calling for. But, if you look at Las Vegas, rents start to flatten out. So what we're calling for might be, a little bearish right now, considering what is happening in Las Vegas and some of the other metros where rents are starting to flatten. And if you take a look at what the chart's pointing at, it's a lot deeper than the Great Recession and what happened in 2001 as well. So while we're expecting, or our forecasts are calling for 9-10% loss for what we've seen so far, and what Mark talked about with the rent collections, these numbers might be a little too bearish right now. That being said, I'll pass it back to Mark, and he'll finish talking about the capital markets.
Great, thanks, Todd. So in terms of the capital markets, it's very hard to tell what's going on because there hasn't necessarily been a lot traded. So what we thought it might be interesting to look at what's happening in the REIT markets by property type. So you can see that industrial here has had the lightest losses, followed by apartment, followed by office, and then there's a gap, and then there's retail. So investors seem to like industrial the most and dislike retail the most. If we look at, delinquency from CMBS, and this would be light delinquency, so only 30 days late as opposed to 120 or 90 days late. Multifamily sits right in the middle, kind of, obviously hotel, retail getting hit the hardest, industrial and office getting hit the lightest. Now, in terms of a lot of these assets hitting the market, I think that they might on the CMBS market, but I think a lot of these local and regional banks, you are not going to see a flood of foreclosures at the market. There's a lot of funds, for example, that set up in the Great Recession, vulture funds, trying to invest in what they thought was going to be a lot of distressed asset in the market, like what happened in the 1990s when RTC was formed. And it never materialized, right? Because the banks weren't going to foreclose because they couldn't afford to foreclose on that many properties at one time. It's the old joke, right? If you owe the bank $10,000, you have a problem. If you owe the bank $10 million, right, the bank has a problem. So I think the bank is not going to do whatever it can not to foreclose on these assets. Now, if you look at investment volume, this is by quarter. So you can see if you look at closely, the first quarter of this year actually came in remarkably strong, even though 1/3 of the quarter, would have been where we were, just starting getting impacted by the coronavirus. I think a lot of those trades were 1031 exchanges, where investors were selling out of one property, buying another property. You've got 90 days to reinvest the proceeds, or you're going to pay the taxes. And I think a lot of these buyers were like, look, I don't want to deal with the headache of trying to find something else to put in this asset that I already sold. I'll continue the trade. The seller was more than happy to continue the trade because they don't want to remarket the property to somebody else in this environment. And those are the kind of trades that took place in the first quarter. And you'll notice this quarter, right, trades really small. I think that we're not going to have really any volume this quarter, any volume next quarter, and really probably any volume for the rest of the year. Because why would you sell if you don't have to, right? The only people that are going to be selling now are going to be those few owners that are selling distressed assets. And what you'll see is that those assets are going to take a beating when they enter the market, because that's what distressed assets usually do. So you might see 25, 30, 35% losses on the value side, but that's not going to be indicative of what happens if you took a good asset and sold it. And what you'll notice here, if you look very closely, if you look at the price per unit, you can see that it peaks in the beginning of this year and never quite gets back to that peak level. Now, at CoStar, we are agnostic on the economy. We do not do our own economic forecasting. What we're trying to do is provide our clients with the general consensus view on the economy, put that into our econometric model and say, hey, given the general consensus view, this is what should happen to commercial real estate. Rents, values, you name it. In this case, what's happening is our forecast for pricing is really being driven by, here's an example of the slides, the value not getting back. They're driven by cap rates. A lot of economic shops do this. You use cap rates to forecast values. Now, what you may notice, right, is this initial jump up in cap rates. This is what we also saw in 2008. In fact, I think that our initial jump up in cap rates might not be strong enough due to the fact that the only thing that's going to be selling for the next year, maybe 2 years, is distressed assets. A regular owner is just going to take it off the market and then wait for conditions to improve and then put it back on the market. So what you'll notice is that cap rates over the forecast don't get quite back to the level that we saw prior to the pandemic. This is really driven by the forecast for BBB bonds, which we get from Oxford Economics, which they don't have going back to kind of normal spreads. In my opinion, we're going to end up with cap rates after the initial blowout, right? So it's going to be a jump in cap rates, but 2 years from now, 3 years from now, when we return to market levels, right? And, we're going to end up with a lower cap rate, not a higher cap rate, because we're going to be sitting, right? The risk spread is going to be sitting on a lower interest rate. The Fed, right, has two primary mandates. One, full employment. I think under that Nike swoosh style recovery, we won't be back in full employment for 3 to 4 years. So for that mandate, there's no reason to raise interest rates. The next primary mandate, right, is inflation. I don't think we're going to have any inflation. People are worried about the government printing money and that leading to inflation. My counter arguments would be that that did not lead to any inflation in 2008 when we did the same thing. Japan has been doing this for 30 years and it has not led to any inflation. And one of the primary drivers of inflation is population growth. Our population growth is much better than Japan's, much better than Western Europe, but it's still very anemic. So we don't get the type of inflation. So I think that interest rates are going to stay low for 5, 6 years, if not longer. And as a result, right, cap rates are going to be lower from 2022 to 2024 is my personal view. And with that, we'll wrap it up and we'll take any questions.
Great. So I got a question for us. I've had a couple housekeeping stuff come in through Q&A. Few folks that are interested with some Q&A, type it into the box and I'll make sure to read it out for these guys to help us answer. With the data that you guys see, I'm working on an equity raise for a mixed use development in the Hudson River Valley, right? So what we're seeing is our project was a 50% commercial, 50% residential, and the developer had already kind of just about pre-pandemic had already gone back to discuss with the officials in the towns to maybe make it a a little bit different split, a little heavier on residential. So we might be looking at a 65, 35, 70, 30 residential heavier. And what we've seen from this pandemic are a lot of reports coming out of New York City that folks are potentially looking to move out of the city into more of a suburb, like somewhere in the Hudson River Valley. Do you see those kind of metrics, or do you see that kind of shift in apartments where, due to something like this, do the tenants change their location? Do they change their class of, do they go from an A down to a B or a C type property simply because of uncertainty or job loss? Do you see those kind of migrations on the apartment side?
People definitely trade down during recessions to B to C. I would say that in a normal recession, people usually stay in the same neighborhood. I don't think that the pandemic is going to directly impact where people work, but I think that you've got two things that are favorable working towards the suburbs. Number one is that we've seen is that, especially with technology companies and with finance companies, law firms, etc., is that they are now saying like, hey, look, people are working from home and they're actually almost or even more productive than they usually were. So rather than have you come into, I don't think we're going to be 100% work from home, but it might be, instead of working in the office 5 days a week, you're working at the home 3 days a week. So now maybe you're willing to do that longer commute, right? You're going into White Plains or Westchester or Greenwich, Connecticut, or what have you. So I do see more people working from home, not 100%. You come in for work, for meetings, for client visits, etc. But I think people might, for that, number one, for the space, and like number two, for the affordability. But there's a longer trend at play that favors these kind of suburban developments, and that is the millennial population. If you were to look at the U.S. population by age, you would see that there's a disproportionate percentage of the population around age 28 or 29, kind of that peak year of millennials. The average age for a first-time home buyer across the country is 32. In Massachusetts, it's also 32. Now, in New York City and the city of Boston, it's going to be higher. Maybe it's 35, 36, etc. But right now, what's happening, these millennials are hitting the years where people typically get married. And it's the marriage, you hear stories of, oh, people are getting married later, blah, blah, blah. And that is true a little bit. People are getting married a little bit later. There's been a gradual shift up since about 1955 in terms of the average age for marriage. But people will be getting married, having kids, and buying houses. The logical step before you buy a house is probably to buy or rent a suburban apartment. So I think we're going to need to see a shift from the cities into the suburbs, regardless of what was happening with the pandemic, just because the demographics in the United States are mandating a shift. And we can actually see an increase in the home ownership rate because of that. And you see, like in Boston right now, there's an article in the Boston Globe that came out yesterday that housing sales, or I should say housing prices, are up 7% like year over year because there's been this reduction in supply. Yeah. So I think that the long-term trends kind of favor the suburbs because of the demographics, and then you add in people working from home on top of that.
Okay, great. I've got a few questions here. Lali Patel is asking if it's a good time for new investors to get into the market. And with your expertise, where do you think investors should focus? So maybe, I'm not sure if that's a geographical, where should they focus, or a property type. But.
Well, If it was me and I was trying to get something at a super steal, you could be looking at hotels. So there's 900. Well, I don't think that most hotels that's owned by, your local or regional bank is going to hit the market. You could have some CMBS loans. And I heard someone say that out of the 900 CMBS hotel loans, that 700 they thought were going to hit special servicing. Now, if you want to take a gamble and you can say, well, look, maybe there's going to be a vaccine in a year, maybe there'll be herd immunity in a year, et cetera. Maybe that's a chance to go in and get a hotel, one of the hardest hit property types at a bargain. Retail maybe less so because you have the problem with e-commerce taking a bigger and bigger bite out of regular retail. I think that suburban multifamily, again, kind of a way to go. And also, too, then the question is, if you have more people living in the suburbs, will eventually some of those jobs move out to the suburbs as well? So then maybe suburban office on top of that. But kind of a lot remains to be seen over the next, year and a half or so. I don't think there's going to be a whole lot hitting the market, but, it's a lot better. Well, it's always harder to buy in the recession. It's always a better time to buy, now than, 6 months ago, or to buy in 2009 and 10 and 11 than it was to buy in 2007 and 2008. So the timing is great.
Sure. A good question to piggyback on what we were just discussing regarding that work from home. Will the work at home, at least for part-time for now, will that paradigm shift affect the size of rental units to accommodate the shifting workspace needs?
Yeah, well, I think that's the advantage of kind of going out to the suburbs, is you can get a little more bang for your buck. So where you might be looking at, and it's going to be on the margin. It's not going to be like everyone's going to go from a 1-bedroom to a 2-bedroom or what have you, but you may see an increase where people were on the margins. We're kind of making that debate, it's you and your girlfriend or your wife or what have you. And you're like, well, we were thinking about a 1-bed, and but now we'll go for the 1+ or maybe the 2-bed on the margin. So maybe call it a 5 to 15% increase in terms of shifting up 1-bedroom or with a some kind of office nook in there.
Sure. Interesting so New Hampshire has mandated towns to allow accessory dwelling apartments since 2017. Do you see accessory dwelling apartments having an impact on the housing supply?
It's going to be a drop in the bucket. I think it's great, but how many basement apartments or garages or whatever can you manipulate in New Hampshire to make that kind of in-law suite? I assume that's kind of what you're talking about, right?
Right, sure.
That's kind of what you saw if you watched one of those house flipping shows that they had in Toronto, right? That's what they're always doing, is like, hey, an income property, I'm gonna take part of that and mix that in. But we need so much more housing. So if you were to look at household formation in Boston and in New Hampshire over the past 10 years versus how much single family and multifamily we have so much more demand for housing than what we've actually built. So I don't think it's great for homeowners to be able to do that, but I don't think it's going to impact anything in terms of the commercial. We just don't have enough housing.
Sure.
At least at the B and C level, we may have in some submarkets, not New Hampshire, but in the Boston submarkets, we have too much Class A. And actually in New Hampshire, around the Ameskeag Mills in Manchester, like rent growth there is doing, or was doing, much, much better than the Boston area.
Okay. Are you aware of any sales or upcoming sales that will reflect a price adjustment and higher cap rate?
I wish, not yet. So one of the things out of this pandemic is the need for information, and we weren't necessarily seeing enough trades in CoStar, and we've got a team of people that make phone calls. They're calling brokers or calling owners, trying to get trades. We're scraping the registry of deed sites, doing whatever we can. And in addition to that, Todd and I have a call set up every 2 weeks where we talk to all the directors of research for the various brokerages. There's maybe about 10 in Boston that we talk to, and like the first question is like, so what are you guys seeing on the capital markets? And it's pretty much crickets all around. So we really haven't seen anything that a deal that wasn't already really in place before the pandemic selling. And what is that cap rate? What's that price per unit, etc. I wish I knew.
Yeah. Okay. I got one more question. If anyone else has any other questions, fire them in, and I'll read it after this one. Otherwise, we can wrap up. Have you heard developers discuss any different mix of amenities in multifamily as a result of the pandemic? For instance, a focus on more common area workspace or more in-home office type spaces?
Not yet. Not yet.
I think maybe just add one thing, maybe something that, not necessarily office workspace within apartments, but something that has been gradually, increasing is, and I live in an apartment, I wish they had it here, is the, refrigeration and cold storage within an apartment complex. You're seeing so much, you see it all over with, Instacart, the rise of online grocery. I think that might be an area where there's more development, more, mix of amenities where, you order on, online and, a grocer comes and puts, all your refrigeration goods within, an area in the apartment complex that, has a cold storage and stuff like that. So it might, you started to see that a little bit before in with the rise of e-commerce and stuff like that. So that might be, one area that you might see the amenities mix up a little bit.
Yeah, I would totally agree with Todd on that. That's actually a point that Sam Zell, from Equity Residential EQR point he made. And I was talking to a property manager one time, just tell you a funny story where someone ordered a bunch of lobsters and they just kind of put them in the regular mail room, and then it all went bad, and it would have been better to be able to put them in some kind of cold storage. So I think we might see more cold storage.
Okay. All right, interesting. And lastly, regarding banks and tightening the lending requirements and offering new programs, what kind of impact do you see for the folks that are trying to trade properties? Do you think there's an impact there as well?
For multifamily, not so much, because you got the GSEs that are still open for business. So we really haven't seen the, and if you look at the office properties and the industrial properties, right, your interest rate's going like that. But for the residential, because you've got, the Fannie Mae and, Freddie Mac, et cetera, that the interest rates are still very, very favorable from what we've seen.
Excellent. Well, gentlemen, listen, we're coming right up on an hour. I think this has been wonderful. We appreciate your time, your insight. I will make available the slides here that you've given, as well as the video. And we might have some opportunities to do some follow-up with Mark and Todd on some other asset classes. So we're trying to ramp up some of our content. And again, Mark and Todd from the New England chapter and our audience, thank you for your time. Thank you for your insight, and have a great day.
Great. Yeah, you're welcome. Our pleasure.
Excellent. Thank you, Todd.
Thank you.
We'll see everybody. Bye-bye.